The Fed has been caught in a crossfire. It's either your job or your money's worth, and they've made their choice, your job. You see, the Fed has two missions.
My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people.
But right now, they can't do both. Unemployment is expected to rise from 4.2 to 4.5. That's hundreds of thousands of jobs lost by the end of the year. So why is the Fed choosing to make hundreds of thousands of people jobless instead of cutting interest rates? Well, this isn't the first time. Back in 1979, Fed Chair Paul Volcker faced the same brutal decision whether to bring down unemployment or fight inflation. He chose to attack inflation. This led to significant job losses as unemployment skyrocketed from 7.5% to 10.8%, the highest rate since the Great Depression. However, by 1983, inflation had dropped from a crushing 14% to below 4%. This kind of decision is based on an economic concept called the Phillips curve.
Don't worry, we won't bore you with theory, but the curve suggests that there's a trade-off between unemployment and inflation. That is, low unemployment equals higher prices, and higher unemployment equals lower prices. This simply means when unemployment is low, most people have jobs and more money to spend. Businesses compete for workers by raising wages, and when people have more money, they're eager to buy things. This demand, combined with higher wages for businesses, can push prices up. On the flip side, when more people are out of work, businesses don't need to raise wages, and spending slows down, which puts downward pressure on prices.
Thing is, right now, prices are too high, and we're still seeing fewer job opportunities. What the Fed is trying to do is difficult but necessary, a short-term correction to fix a broken system. The idea, fewer jobs for now, but in the long run, your dollar regains its strength. It's painful today, but the goal is for your money to buy more tomorrow. So, how does this affect you?
Besides the obvious, job insecurity, there are real pros and cons to this situation that 9-to-5 workers should pay attention to. So the first pro is the increase in your purchasing power. If inflation truly comes down, your hard-earned dollar buys more groceries, more gas, more of what you need. That's a direct raise in your real income, even if your paycheck doesn't go up. The second pro is there's the potential for future rate cuts. President Trump has been pushing for rate cuts, but once inflation is truly beaten, the Fed will cut rates. That means cheaper mortgages, cheaper car loans, and a boost for many investments down the road. Next, you'll see better savings returns. If you're saving money or investing in short-term instruments like CDs or treasury bills, high interest rates mean your money is working harder. And finally, a crucial pro for the 9-to-5 worker is a stable future, meaning a stable economy where prices aren't jumping all over the place and your retirement savings can actually hold value. A stable economy makes planning and investing more predictable and less stressful.
Now the cons.
So the first con is job insecurity. We already mentioned this. Even a small uptick in unemployment is a huge deal if you're the one who loses your job. It creates anxiety, stress, and uncertainty for everyone. The second con is slower wage growth. Even if you keep your job, it might be harder to ask for a raise. When more people are competing for fewer roles, companies feel less pressure to increase pay. That could mean smaller raises or none at all. This uncertainty is exactly why you should subscribe to this channel for investment strategies to beat inflation and stay financially informed. Next con is tougher borrowing conditions. Whether you're trying to buy a house, a car, or just manage credit card debt, high interest rates make everything more expensive. That can delay your goals or even shut them down completely. And lastly, slower economic growth. Higher rates cool inflation, but they also slow down business activity. That means fewer startups, less innovation, fewer new jobs, and a general feeling of economic stagnation.
So what should you do as an investor? In uncertain markets, diversification is your best defense. Don't put all your eggs in one basket. Instead, focus on companies with strong balance sheets, consistent profits, and essential products or services that people can't live without, even in tough times. And remember, market fluctuations are normal. So focus on your long-term goals and avoid making emotional decisions based on daily news cycles. Also, plan ahead. In an environment where unemployment could tick up, having a solid emergency fund, 3 to 6 months of living expenses, and an easily accessible account is more crucial than ever. And finally, stay informed. We will keep bringing you updates every week to help you navigate the market.
The turbulence isn't over, but knowing what's happening puts you ahead of 90% of people. Don't wait for the headlines to tell you what to do. We simplify what the Fed says so you don't have to decode Wall Street and help you stay one step ahead of the chaos. So if that sounds valuable, hit the like button, subscribe, and let us know in the comments, what's your biggest concern right now?